Good afternoon, and welcome to the Business Exits Insights webcast. And today on the show, we have Bill Alderman. Bill, a good friend of mine, is also the founding partner of Alderman and Company, an M&A specialist in the middle market of the aerospace and defense industry with over $2 billion in mergers and acquisitions related transactions. Bill has been quoted as an industry expert by Aviation Week, Bloomberg, Reuters, and a host of other major publications. And Bill is a commercial pilot with over 30 years of flying experience, and he owns and operates a Cirrus SR-22 aircraft. Among other volunteer activities, Bill is an active command pilot for Skyhope. Welcome, Bill.
Thank you, Nate. It's great to see you. Unfortunately, not in person. We'll do that soon enough, sir. But great to see you, and thank you very much, and Raymond James, for having us on this. It's an honor, a privilege, and I hope that your audience finds this to be productive and helpful.
I'm sure they will. First, let's learn a little bit more about Skyhope. Tell me, what is that, and what is a command pilot?
Yeah, so it's a wonderful charity, and if anybody watching this is a pilot or has friends that are pilots, it's a wonderful charity. I started flying with Skyhope about, I want to say 8 years ago. I had a good friend of mine, Scott Ashton, who runs a aerospace company in the oxygen sector called Aerox. So Scott and I were friends. We'd worked together years ago, and I knew he was a pilot. He's a very good pilot, what they call an ATP, which is the highest category. And so we're friends. We work in the industry, and we would fly together every now and then. And he told me he was on the board of directors of this charity. And so I because of him, I learned about it, and then I joined the organization, became a pilot and a command pilot. And it is a charity. Many people are familiar with a charity called Angel Flight, which is large corporations mostly, but some wealthy individuals with very large jets will transport mostly children with cancer cross country for very specialized treatments. They do other things, but that's the core of Angel Flight. PALS was the original name. It changed its name a year ago to Skyhope. And Skyhope is a northeast, although it's now the whole East Coast. But we don't fly jets. We're flying smaller aircraft like my single engine Cirrus SR-22. And we don't fly transcon. But if someone needs to go from northern Maine to Boston for mostly cancer treatment, that's what we do. And so we're filling a gap of not super long haul, but regional. But I've done a number of missions where I'm flying someone for their weekly, monthly chemo treatment. And these are ambulatory patients. We're not a medical ambulance, right? These are not really sick people. These are people you would know that are going to get chemo. And they're relatively healthy, and we're able to transport them just like being in a car. But I transported a gentleman a number of times, and his commute by bus, etc., from his home to cancer treatment is 7 hours minimum. And he would go by himself 7 hours, get chemo, stay in the treatment center for 3 hours, and then tired from chemo, 7 hours back home. And we can do that trip in an hour and 20 minutes, or give or take a little bit. And that's the charity. And people ask me, why I do it or whatever. And it is my little way of giving back. I love to fly. It's my favorite place in the world to be. And people that we fly thank us so much. Like, oh, you're so great. Thanks for flying me. And I really mean this. I get more out of flying them than they get out of the quick trip that I provide to them. It makes me feel like I'm not just a lucky guy with an airplane having fun. In some way, I'm trying to give back a little bit.
Wow, that's great. And, I hope that someday I get to fly with you, not, of course, as part of Skyhope, but maybe,
Exactly.
maybe as a co-pilot who doesn't know how to fly, um, but it sounds great. Now, did you start flying planes before you started working in the A&D space as an M&A advisor, or vice versa?
No, and I tell my clients, I'm very transparent about it. I am a banker second. I am an aviation nerd first. And so as a little boy, I wanted to be a pilot, an astronaut, and then I wanted to be a pilot, fighter pilot, fly for the Navy, whatever. And couldn't be an astronaut, couldn't fly for the Navy. I wear glasses, and in today's world, they'll correct your eyes with LASIK, but back then they didn't have the ability to do that. So the Armed Forces said, sure, you can come work here, but you can't fly for us. And then I was flying in the airlines, and the airlines were all in financial trouble back then. And it was hard to find a job as a pilot, and the pay scale was low, and a lot of Vietnam vets were looking for work, and so the airlines would tend to hire military pilots first. It was a tough market to get hired into, and so I got my license and pursued it a little bit, and then realized it just was going to be a rough patch, 5-10 years of very low compensation, and I was not willing to pay the price. So I went into finance and became a finance geek in aviation, and I got my fix by being associated with aerospace and defense, and then I was able to earn enough of an income that I could buy my own airplane. So that's how I resolved the dilemma. Looking back, I think slogging it out for 5 or 10 years would have been rough. I would have been eating a lot of ramen noodles. I think it would have turned out okay. I would have had a good life. I would have enjoyed it. I love what I do. And so I'm sort of glad things worked out the way they did. I'm still a pilot at heart, but I'm a banker by trade.
Well, it seems like an incredible journey, and I am grateful that you are here where you are now. And I'm sure that you help a lot of people either through Skyhope or through Alderman and Company. And I'm sure they're grateful that you are where you are. So,
Thanks,
so
Nate.
let's jump into two truths and a lie. Give us two truths and a lie. I will try to, sniff out what that lie is. Hit me.
All right, you ready?
Yes.
Okay, I'm going to make it a little easy and then a little tough.
Okay.
My favorite hobby is flying. I weigh 170 pounds, and my favorite color is blue.
Okay. So obviously, so your choices, your two truths and a lie is favorite hobby, flying. You weigh 170 pounds, and your favorite color is blue. So obviously, flying is your favorite hobby. That we can cross that off as that's not the lie. I've met you in person, and you strike me as somebody who weighs more than 170 pounds of solid muscle. You seem very fit, so I'm gonna cross that out. But blue, that is also the company colors, so I'd want to cross that out as the lie also. But I'm gonna just say, well, and you do like to fly, so you're up in the sky, so the blue horizon. So I'm gonna have to go to 170 pounds. That is the lie? Yes, maybe that's what I
You're the
said.
man.
You weigh
You're the
like
man, Nate.
180. I'd say you like weigh 182 pounds.
Wait, you didn't say I had to say how much I weighed. I just had to
You
give you a
did.
lie, Nate. Come on here. Come on. Come on.
Well, as I said, it's all muscle.
Yeah, I
For
wish. I
anybody
wish.
out there who's
I
worried
wish.
about Bill. He seems like he's in great shape, and he'll probably be living a very long time
I
and
think you are
help a
more
lot of
lean
people.
than I am, sir, but we'll have that fight
Uh,
over our next lunch.
Sounds good. Great. So, thank you for sharing that. Let's talk about the A&D, the aerospace and defense M&A market. What is happening?
Yep. So what I'd like to do, Nate, is answer your question and your questions because you shared with me where you wanted to take the conversation. What I'd like to do is break it into two basic parts, and then we can do whatever you would like with that. The first part is I want to answer the question about what's going on in the market, what's driving the market, and the second thing I'd like to do, which I think maybe more relevant for your audience, is talk about value. How are companies being valued? And I think that's a really nice conversation for us to have after we talk about what's driving the market, because what drives the market drives value. So, with your permission, sir, that's where we're going to go.
Oh, permission granted.
Thank you, sir. So, the market. So, um, there are macro themes that drive aerospace and defense. And one of the wonderful things about this industry is that it's relatively easy to look down range 3 to 5 years and forecast cash flows. It's a really interesting market. I don't know other markets. I really have never, since 2 years out of grad school or something, in the past 35 years, I've done nothing but this. And so I don't really know other markets, but I keep hearing from people, you're lucky because you can forecast so easily. And for those that may not know the aerospace and defense industry, these are very long lead time assets. And if we talk about the either production or maintenance of these assets, that's the cash flows, right? So when we talk aerospace defense, we're talking companies that serve or produce products, fixed products, service products in the aerospace and defense industry. So if you're refueling airplanes at the airport, you're in the aerospace and defense industry. If you're making battleships, which we don't make anymore, but as a widget, if you're making battleships, you're in the aerospace and defense industry. So that's how we define the industry. And our market is not the very top of the industry. Our clients are not the multi-billion-dollar enterprises building battleships, as an example, or building airplanes. Our clients are companies that either tier 2, tier 3, however you want to define it, Nate. They could have 100 million in revenue, they could have $1 billion in revenue, but they're not the very top of that pyramid. Okay. And as we look at those markets, the aerospace and defense industries, which can be broken into two sectors, commercial and non-commercial, they can include space, are extremely productive at the moment, and there's strong demand. And that strong demand that we're seeing is driven really by two factors. And factor number one is the defense budget, for good or for bad, is going up a lot in this country. We're now hitting darn close to $1 trillion. We can make a comment about stability in the world and sort of why we're in this point, but to us as the bankers in this sector, we accept where we are and then we advise our clients. And what we see is that the world's not going to get a lot safer anytime soon. And the budget, whether we change administrations or not, probably is not going to change that budget a lot. And some of these programs are very long lead. And so Golden Dome and other things that we're probably going to have to do to protect our nation, forget politics, are driving the defense industry to spend a lot of money to protect the nation. That's one stream of drivers. The other stream of drivers is commercial aviation. People want to be on airplanes and travel. And the last cycle we went through, which was the pandemic, was horrific because no one wanted to fly. But the one before that was 9/11, when no one wanted to fly. Civil aviation is a luxury. Even going to a wedding, a funeral, a birthday party, a business meeting, you can find ways, especially with technology today, like we're doing right now, you can find ways to get things done without getting on an airplane. And so when people have fear, concern, economic concern, safety concern, they don't fly. It is a discretionary good, and it is a relatively elastic good. Okay? Yeah, I need to buy toilet paper whether we're in a pandemic or not. I do not need to go to the Grand Canyon on vacation if we're in a pandemic, or if it's after a terrorist attack and I'm concerned about my safety. And so commercial aviation swings heavily from time to time based on exogenous shocks, basically shocks that cause people to not want to fly, because we believe the natural way of our society is people want to travel and they want to spend their disposable income on it. And businesses believe, even still with robots and all the rest, flying to a business meeting is productive. But it's elastic. We're in a place right now where the elasticity is in favor of travel. And so we can all think about the last time we took a flight, how many empty seats were there? None. Okay? Right. And you don't need to be an expert in the aerospace industry to know that full seats probably means people are making profits. Supply and demand is just, obviously it is sold. It'd be strange if these guys were all losing money. So the commercial aviation market is very strong because there's demand to travel. The defense market is very strong because we have an unstable world, and we have wars around the world, and we are spending more on defense. That's what most Americans agree with, forget politics. And so if you're in the aerospace and defense industry as a supplier of a product or service, your company is probably profitable right now. And as we're going to talk about in a few moments, profits are a meaningful driver of the value of companies.
Great. So I heard that these large macro themes give you long range visibility into the industries. And right now, the industry is productive. and there's strong demand for M&A activity because defense budgets are up, or defense budget is strong, near $1 trillion, and there's a lot of travel demand. Did I get that right?
100%. And because the defense budget is up and you don't build defense weapons overnight and then cancel them overnight under most circumstances, you have visibility that, oh, I've got to make 100 tank parts over the next year. Oh, I've got to overhaul 300 helicopter jet engines over the next year. Visibility. Oh, we've got to make flap controls for Boeing's production line. That's a year's worth of design, engineering, and production planning. And so you just said it perfectly, that if you're on those programs, things can obviously change. But for the most part, you've got very good visibility pretty far downrange.
Mm-hmm. Okay. So what drives value?
Isn't that a tough question, right? Don't you get asked that all the time? It's a really tough one, Nate, and I've wrestled with it for 25 years. I finally think I've gotten to a place where I'm beginning to understand value. And I'm not being facetious when I say that. The way we're seeing aerospace and defense companies valued, and the way we've seen this over my entire career, which I now am better understanding, is value is determined by the buyers. Period, full stop. Now, whether transactions take place is up to buyers and sellers. But who sets the price? Buyers set the price, because sellers can want whatever they want. They ain't going to get what they want unless a buyer agrees to it. Okay? So I've really come to a place where I'm very comfortable that, of course, sellers have a 50% say in the matter. Deal's not going to happen without their agreeing to it. But what moves the market is the buyer. Okay. If there are a lot of buyers, prices go up. If there are no buyers, prices go down. Of course, the sellers matter. No sellers, prices go up. Lots of sellers, prices go down. But I'm going to talk about in a moment here why it's the buyers who determine price. A seller can set a price for emotional reasons. The seller can set a price for any reason they want. They can do their own valuation work. Okay. But when you're negotiating with a buyer, you have to understand how that buyer is thinking, assuming you have a rational person on the other side. Let's take the irrational off the table, okay? What's a rational buyer do to value a middle market aerospace and defense company? Well, it depends on who the buyer is. We see three types of buyers using three types of valuation methodologies. Small buyer. So to put numbers on it, let's say that all the transactions we're talking about are $30 million transactions. Okay. So it's a $30 million sale, period, full stop. That's what we're selling. A really nice company, nicely profitable, good programs, good reputation, $30 million in revenue, good profit margins in the aerospace defense industry. And let's just pretend that it's going to be worth around $30 million, give or take, to the average buyer. How does a small buyer look at that? A small buyer looks at that and says, well, I've got 40 million in revenue. This is a big acquisition for me. How am I going to pay for this? Most important thing, how can I pay for this? I've got my own real estate that's unmortgaged, and I'm talking work. We're not talking so small that people are talking about their 401ks to buy companies. We're talking about a company, right? Where the owner of the company says, I have 40 million in revenue, we own our building, we have no debt, we could borrow X number of dollars on our own account, but we need more to buy this company. Can we get an SBA loan? Will the seller accept some seller financing? Are my wife and I willing to put in some more equity into this business? It's driven by financeability. What can I afford? And if I borrow X million dollars to buy this company, what's my debt service? Can I get that loan approved? What's my cost of interest? What if interest rates go up? It's a variable loan. Can I afford higher interest rates? It's all about financeability. Now, It doesn't mean that the individual never went to business school. It doesn't mean that they don't have an advisor doing a discounted cash flow, or they didn't get comps and are looking at multiples. It doesn't mean they're not doing other things. But what's driving them? What's driving their valuation? They may think the DCF is 33. They may think that the EBITDA multiple is 34, but all they can afford is 29. What's driving that buyer? What they can afford. All right, let's move to the next buyer. Next buyer, we're calling that a middle market company themselves. Maybe call it a large company with $300 million in revenue, company with a $60 million line of credit. For that company, they could call their bank and draw down the line and buy this company in a heartbeat. They may have to get approval for the line draw, but this isn't a financeability issue. They probably got $12 million cash in the bank, a $300 million business. So this isn't for them, how do we finance this? This for them is something else. Obviously, they care about financing. Well, if we use this cash for this, we can't buy that new facility we were going to buy. If we do this, we won't be able to do a new roof next year or whatever. I mean, money matters, liquidity matters. It's not that this larger company ignores financeability, but it's not the driver. The middle-sized company looks at discounted cash flow, internal rates of return, payback ratio, metrics more along the lines of the things the smaller buyer thought about, but didn't drive their number. The smaller buyer may have done a discounted cash flow. It just didn't drive their decision making. The middle market buyer may look at financeability, but it's probably a non-event. They're looking at things that mean more to them, like discounted cash flow, IRRs, payback ratios. And then you go all the way to the public company and you look at, pick your favorite multi-billion-dollar public company. If they're going to buy a small business, or any business, but a small business, what's going to drive them? Strategy, market share, competition, earnings per share. Is it accretive? Of course, they're going to look at a DCF. Of course, they're going to look at financeability and payback ratios and IRRs. But what's going to be the ultimate driver? Something different. Could just be strategic. Could literally be, we need more business with Boeing. And if we can get a toehold in Boeing, we could do hundreds of millions of dollars with business with Boeing someday. So, okay, it costs us $30 million to get into that market. It could be literally that kind of analysis. And so what we say to our clients, and I've really learned this, Nate, just over the past few years, that of course, all these methods are used by buyers, and we all know what they are. And my team has models, and we can run them all basically with our eyes closed. But the real issue is understanding the buyers you're dealing with. And if you think how they think, you're more likely to understand the value you're going to see. And so we get asked all the time, well, why did that company sell for such a high price? Well, who's the buyer? Why'd they buy it? And we often see the smaller companies saying, I can't believe these crazy prices these people are paying for these companies. This is nuts. I want that. And the response is, well, okay, but that's not relevant to your world. Yeah, it's like saying you're selling your condo in Stanford and you want the same price as the mansion on the Hamptons Beach. No, I'm sorry, right? They're not comparable. They're not comparable. And so anyways, it comes back down to the issue of understand your buyer market, understand how they're likely to value your business. And if you have the right expectations, you're probably going to be very pleased as a seller because you're going to wind up getting what you want. But if you look at, that company sold for that price, I want one of those, and you don't do the homework to understand what happened there and why, you can be disappointed as a seller.
Very interesting. So value is determined by the buyer, and it's good to understand how a buyer is thinking. Small buyers, they're looking for financeability. how are they going to pay for it? Middle market buyers, more along the lines of profitability. They're looking at the DCF, the IRR, payback period, and a public company compatibility. They're looking at, does this fit our strategy? Is this make us more competitive? Does this enter us into new markets? Is that right?
Yes, and also the impact on earnings per share, even small deals. Public companies, their management teams and their boards are incentivized by the shareholders to drive share price, which is in large, and this is your world, not mine, Nate. Share price
Mm-hmm.
can be driven by earnings per share.
Mm-hmm. Uh, that's very interesting. So yes, I sold my company in 2019, and we sold to a $1 billion private equity backed strategic buyer, and we sold for a tremendous multiple on EBITDA. I mean, it's almost embarrassing to say, but for
Congratulations.
them, they got a lot more out of it than just our earnings, more than just our EBITDA. Obviously, financeability was not an issue for them. They were looking at more than just the profitability. They were looking at um, our name recognition, right? We had a
Of course.
pretty big name in the industry. We were not in the aerospace and defense industry, but we were notable. We had an iconic name in the industry that we were in. We also had the best in class tech stack. In fact, the buyer ended up adopting our tech stack for their entire operations. They
Right,
were 10 times
right.
bigger than we were. And so that it worked really well for their business. They got a lot out of it, more than just our EBITDA.
Exactly. Exactly.
Interesting. So that's all really good to know. Let me ask you another question here. At what stage in a company's life? Oh, by the way, for those of you who are attending, I would like to invite you to go ahead and ask questions. There's a little icon down at the bottom that says Q&A. Please feel free to add your questions in there. I'm going to ask Bill another question here. What stage
Sure.
in a company's life cycle does it make sense to start considering a sale or pursuing institutional capital?
So I'm gonna do the institutional capital first because I don't do it and I can cross it off. Right. So
Okay.
um, raising capital is, and look, your firm, Raymond James, is world class at doing many different things in the capital markets, not just wealth management and exit planning, but capital raising and corporate finance. And I mean, you're a huge, well respected organization. We're just a little boutique and we do one little thing. We sell aerospace and defense companies that are middle market, a lot of them privately owned. That's all we do. And when we get asked by potential clients, well, I think I don't want to sell my company. I want to raise capital and grow. Our response is go at it. I mean, good luck. It's the American way. It's wonderful, but we don't do that, right? And so we just sell companies. I know it sounds like, well, aren't they related? Aren't you an investment bank? And like, no. Yes, we're an investment bank, but no, that's not what we do. And so raising capital will take off the table. We just don't do it. So if someone says to us, we're thinking of raising capital and growing our business, our response is, here's some people to call that can help you out. When someone says, I'm thinking of selling my company in 2 or 3 years, my response is actually, and I own this response. Nate, you say some things and you believe them in your soul and you just say them over and over again. Someone asks you the question, it's like, it's going to sound canned, but I really believe this. And it's just the answer that I really believe, right? And I own this answer. You should be thinking about selling your business from the day you started. Now, doesn't mean you should ever do it, but it should at least be on your mind a little bit. It's like you're working your tail off. You're employing a lot of people. You're growing. You're building something. What? You're going to live forever? What? You're never going to die? Or what? You're never going to want to retire? Now, you could have children, and your third daughter may say, I want to run the business someday, and she's awesome at it, and that's your plan. But to not have a plan, I mean, the classic entrepreneur that we know in the aerospace defense industry, they are brilliant, they are personable, they're customer focused, they're loyal to their employees. I mean, they're rock stars, right? They're rock stars, but they stink at one thing, planning their own legacy. They stink at it. It's like, why? You're good at everything else. Why are you ignoring yourself? Because you're not ignoring yourself, you're ignoring your family. Okay. I mean, the typical deal we do is 30, 40, 50, $60 million, usually for one family. That's generational wealth. You've worked so hard, you do such great work. You got to think about your descendants. It doesn't mean you should every week be thinking of selling your company and put an offering memorandum in the market and hire a banker and talk to buyers. That's not what I'm saying. But just like you should talk to your wealth manager and your estate planner, and you should have a will, for goodness sake. You should just, we're not all going to live forever. You should have plans. You're working too hard, you just let it unravel. Okay. And so what does that mean? It means think about selling your company once a year, twice a year. Talk with your wife or your partner or your friend or whatever, or your number two executive. What are we going to do if I get hit by a bus? What are we going to do? Oh, and by the way, what am I going to do when I'm 65 years old and want to retire? I have to work the rest of my life. So what does that mean in conversations with someone like me? It means I'm going to tell you to have a wealth manager. I'm going to tell you to have a good estate planning lawyer. I'm going to tell you that you should have um, a succession plan today. If you get hit by a bus, what are we going to do with you? Okay. And you should have a long-term plan. I want my 13-year-old daughter to be the CEO someday. Okay, fine. That's a plan. She may not want that, but that's a plan. Okay. And then you spend the next 20 years thinking about it, working with your daughter. And one day she says, I want to be a cellist. And you're like, you need something, you need a plan. Okay, fine. But plan. That's all I want to say. You've got a good accountant, you got a good lawyer. Just talk with them once a year. What if I get hit by a bus? And what am I going to do when I want to retire? And have a plan. And these people are brilliant people. It's not hard for them. Just sit with your professionals and have a conversation. And if you are ready to sell, truly ready to sell, no kids in the business, you're going to sell, you're 66 years old, you're going to sell when you're 68 years old or whatever the plan is, about 3 years before you go to sell, banker, lawyer, M&A lawyer, accountant with M&A transaction experience, and you just get ready to sell. And if you take 3 years and you work on it a little bit, and your CFO is aware of it, and you get the records straightened up, and your contracts administrator is aware of it, and you're missing a signature on the Boeing contract, you'll get that fixed. It's not a crisis. You don't need to run around like a chicken with your head chopped off. Oh my God, we're closing on a deal in 3 weeks. We got to fix all this stuff, which I've seen. Instead of that, you have 3 years. Yeah, we'll fix that. Yeah. Oh, the roof. Yeah, we'll fix that. And then you have an orderly process with a reasonable price expectation. You know who the buyers are that you want to talk to. And this is nothing more than another project for you and your business, if you plan for it. Otherwise, it's a fire drill. And fire drills is not how you should be running your company.
That is all great stuff, Bill. And that is what I see. Most of the business owners that I speak to on a regular basis, they come to me and they just don't have a plan. And they say, Nate, I'm going to sell my company and I'm going to end up paying a bunch of taxes. And can you help me avoid paying those taxes? And I say, great. So when are you going to sell your company? And they say, oh, like 2 or 3 months. Well, unfortunately, if you get an offer to buy your company and you haven't done any planning, you're going to end up paying taxes that you could have avoided altogether. So rather than letting circumstance dictate your future, start talking to advisors early. Ideally, when you start your business, create a plan. And that is why I have a quarterly exit planning webinar. My next one is November 5th. And it helps people identify the 5 elements of a successful exit. And I draw on my personal experience selling my business and working with dozens of other entrepreneurs and executives. And that is the thing, right? You need to have a plan. You need to identify your goals. As you said, people stink at legacy planning. You see it all the time, right? And here are a couple stats for you, right? 75% of business owners who sell their company profoundly regret the transaction just 12 months later. It's not because they had a bad transaction. The transaction's great. It's because they didn't plan for the next chapter, right? And Look, selling your company is a great experience. I know it. It's amazing experience. It's something that most of us only do once in our lives. And I highly encourage everybody to consider that experience. But have a plan. Have a plan. Talk to your advisors, talk to your certified exit planning advisor, talk to Bill. He knows all about this. Um, and
Agreed. Agreed.
it's super important. So
It is.
thanks for
It's
bringing all that up.
it's very complicated, but it's very simple, right? So you really do need professionals. Some of the tax things, Nate, are just so complicated and they change so fast. You do need professionals, and it can get very technical and complicated. But the concept is so simple. It's just plan. It really
Yeah.
is a simple concept.
Yeah. Yeah. And just going back to what you were saying, getting ready to sell your company the day that you start your business. When I took over my company in 2011, it was very much of a family business, and that's the way it was run. And from the moment I stepped in, I started making it more of an institutional business. And I transferred from cash accounting to accrual-based accounting. And I made sure there was no key man risk, right? The business was not dependent on me or any one of our employees.
Right.
We memorialized all of our processes and we updated them on a regular basis. And then finally, we got, as I said, best in class tech stack. And I did that not because I was thinking about selling the business. I wasn't even considering selling the business, but I
Right.
did it because I hate putting out fires. I
Right.
hate I hate having problems. I didn't want to work so hard. And this was the way to create a more
Right.
enjoyable business. Oh, and by the way, it becomes more profitable, more scalable, and more interesting to buyers if just say one day your board of directors accepts an unsolicited offer from
Right.
a strategic buyer, you know? So
Yes, sir. Yes, sir.
yeah, start from day one, making it a sellable business. So, Bill, anything to add to that?
No, I agree with you 100%. And it doesn't require a lot. It's an analogy would be your insurance renewals, right? A well-run company has proper insurance. Premiums that are appropriate, not excessive, coverage that is appropriate, not excessive, not too little, not too much. And maybe once a year, you as the owner sit down with your insurance broker, advisor, whatever you call them, and you review your insurance. You spend a half an afternoon on it. You have lunch or whatever, breakfast, whatever, and then you go back to work. And for the next year, you got proper insurance. It's the same kind of thing. It's like, would
Yeah,
you really run your business without knowing if your insurance is the right stuff and maybe it lapsed and you just ignore your insurance? Come on, you'd never do that. But why would you not spend 3 hours a year thinking about your estate, your exit plans, your taxes, your legacy, your succession plan? 3 hours a year, really? And think about the repercussions, right? It's worse than not having insurance in place. It could be the end of your business. If you get hit by a bus and there's no proper plan in place, it could really destroy your company.
yeah. And from what I understand, another statistic out there, which could be bogus, but 87.3% of all statistics are bogus. But from what I understand is 50% of companies that do sell 50% of them sell under duress. That is because of distress, disagreement, divorce,
Yep.
death, or disability. So
Yep.
even if you don't have any plans on selling,
Right.
you need to be prepared because something like that could happen. And that goes back to what you were saying, insurance. So we have a good question. I want to move on. We have a good question here.
Sure.
What kind of multiples are being achieved in this market now? Say 20
I love
million
that
top
question.
line, 5 million EBITDA.
I love that question. So I'm going to give a three-part answer to your participant. Um, if your business is attractive to public buyers, you could be accretive to them at an earnings per share multiple of more than 20 times. The markets better than I do, the public markets, but a PE multiple of 20 right now is light, correct, Nate?
Mm-hmm.
Yeah.
Yeah, absolutely.
And so if a public company buys another company at 20 times earnings per share, and they're trading above that, that's immediately accretive. That's how it works. And although it may be a small deal and the stock price won't go shooting up, it will not cause the stock price to go down, all things being equal. Right. And the world's not always like this, but all things being equal, that's a accretive transaction at a 20 multiple of net income. Correct, Nate?
Mm-hmm.
So your $5 million EBITDA business probably is a $7 million. Sorry, excuse me. Other way around. So take $2 million off of it. So your EBITDA has interest and depreciation taxes added back. That 5 million might be 3 million at the bottom line, give or take. We don't know the exact company, but our person here, our friend here, might have a $3 million net income business at a 20 multiple of net income. That is a $60 million business. Okay. A public company could easily pay $60 million for that business if they, for strategic and other reasons, thought they needed to buy it. All right, let's go to our second buyer, the DCF buyer. Okay. The DCF buyer would probably accept, depending on risk adjusted returns, an IRR in the high teens or low 20s. Okay. I just know my own math. I know that's going to equate to something like a $40 million valuation, give or take a little bit, based on that DCF IRR, assuming a certain growth rate, CapEx, working capital. I mean, right, I don't have a model in front of me, but I've been doing this for all my life. That $5 million company probably would DCF out to about 40 million bucks. Okay. The small buyer that has to finance that acquisition on that $5 million probably can't pay more than $20 million for that business. And again, I don't have a model in front of me, but you go to the bank and the SBA and they do all the rest, and you got to put some equity into it. They probably can't finance more than $20 million. Okay. Now we can convert that into multiples easily, right? So what did I give you? 20, 40, 60, right?
Yeah, you said, so I wrote that down. For public companies, it's basically 11 times EBITDA. For a medium-sized company, middle market company, you're looking at 8 times EBITDA. For a small company, you're looking at about 4 times EBITDA.
Yeah, and here's the thing, and I'm happy. And when we talk with clients, we're happy to speak their language, right? I was an executive at GE when I was early in my career, and I loved it. It was phenomenal training. GE had amazing training programs, and I was literally sent to Boeing to attend some of their training programs. They were cross-pollination events, and I was in a great meeting with Boeing, and they talked about, and this is back when Boeing and GE were both wonderful companies back in the 90s. Talk to your customer in their language. And they weren't just talking about when you sell an airplane to Japan Airlines, you speak Japanese. They were like literally like live their culture. If Japan Airlines prefers a fax, and there weren't even emails back then, but whatever you want to call it, a fax versus a letter, send them a fax. If they like to have a vice president speak to a vice president before a director speaks to a director, whatever they want, speak their language. It didn't mean cave in on issues, right? It didn't mean be a wallflower and just get run over, but it meant communicate with your customer the way they want to be communicated. And I do the same thing with our clients. If our clients want to talk about EBITDA multiples all day long, we would love to talk about EBITDA multiples. It's not how deals get done. It's not how companies get bought and sold. But we're happy to have the conversation and convert reality into that language that they prefer. So I didn't say to you that a public company is going to pay an 11 multiple. I said how they're going to get to their valuation of 60. But I can convert that to an EBITDA multiple, and I'm glad to do it, right? So the multiples you just calculated were what, 4, 8, 11, something like that?
Yeah, actually 4, 8, 12.
4, 8, 12, okay?
Yeah.
My brain can't do that. I mean, obviously I can do math, but my brain doesn't say, what are you going to sell for? What's the multiple? My brain says, who's the buyer? How are they going to value your company? And in your language, that equates to this kind of multiple.
That's very insightful. Never thought of it that way. Fantastic. And probably most people don't think about it that way. And that's why they hire you as an advisor.
Glad to
So
help.
Along these lines of the different types of buyers, tell us, how does a PE buyer differ from a strategic acquirer in their approach to diligence and valuation? Well, we already talked about valuation, but just
Yeah.
diligence.
Well, but there is a difference in valuation, Nate, if you want me to do that for a second.
Okay.
So we talked about the three classic company buyers: small, medium, large. The private equity buyer, the middle market private equity buyer, is slightly different. The very large private equity buyer acts a little bit like a public company in that most very large, and I'm talking very large, private equity platforms will go IPO. Not all of them, but a lot of them are so large that the best exit for that PE firm is an IPO, depending on the IPO markets. And I know you know this, shaking your head. And it's a classic private equity to public markets activity. And so let's ignore the $5 billion private equity company, okay? Because those are acting like public companies. The middle market private equity, and I'm not talking about tiny private equity, because tiny private equity acts like a small company. How do we finance this acquisition? So two people in an office in a city with no money that call themselves a private equity firm aren't really a private equity firm yet, right? They're two people that need money to buy companies, and financeability drives them. But middle market, call it 500 to 5 billion of assets under management. What drives them? What really drives them is the exit, because these firms are structured to manage funds from limited partners. They invest. Roughly 5 years later, they want their money back with growth. That's the investment thesis. Right? You know more about this than I do, Nate. It's a 5-year hold. And so, whereas the company, whether it's small, medium, or large, might own something forever, right? They're not looking to flip things. The private equity firm really is just a long-term stock trader. They want to buy a stock and sell it. It's not next week, it's 5 years later, but they have to sell it. Have to. That's the way their organization is structured, and their contracts with their LPs. They are required to sell these. So what that means is they're not necessarily driven by the same metrics of the buyer that says DCF, financeability. What they're really driven by is, can I buy something and build it and grow it and sell it for more money? And so the private equity buyer looks at value more so of a, can I buy it for a price and sell it for a higher price 5 years later? That's what drives middle market private equity buyers, is who am I going to sell it to, and can I sell it for more money 5 years later? All right, there was a second
Okay.
question there about due diligence.
Yeah, and just to recap what you just said, so PE buyers in the middle market, their exit drives the value. Can they sell it for more money in 5 years and obviously clear their cost of capital? Whereas a strategic buyer in the middle market may have a longer hold time. They're not so concerned. They're not thinking about the exit. They're thinking again about the profitability, maybe the DCF, IRR, and payback period.
Exactly. Well said, Nate. You asked about
Fantastic.
you asked about due diligence.
Yes. And so how can sellers prepare for due diligence for each type of buyer?
So for the most part, and again, every deal is different. You can categorize due diligence based on size for the most part. You can make an argument that private equity firms are a little tougher on due diligence than strategics. We'll come back to that in a minute. But the real difference is big versus small. The small buyer that can barely afford the financing to do the transaction has a limited budget for professionals to work on due diligence. And he or she is running a business, and they're also the window washer, and they're also the janitor, and they're also the IT manager. They don't have a lot of time to be going through general ledgers. Okay. So what we find is that on the lower end of the market, where we don't really play that much, we just barely touch that part of the market. a, a buyer of a company that has limited resources will not spend a lot of money on accountants and lawyers to do due diligence. And that's where the diligence gets heavy. The business people typically are not the ones with the most demands on due diligence. Even large corporations, the business people to the business people, the salesperson to the salesperson, you want to sell your business to some big Parker Hannifin, or pick your favorite large company, Lockheed Martin. The business people can go in and in one day meet with your business people, operations, manufacturing, quality control, sales. One day they're done. I mean, literally, one day they're basically done for a company this size. The lawyers and accountants could take 2 months. And so the issue is, if you can't spend a lot of money on accountants and lawyers, you can't do that. And so what we find is that it's the larger private equity firms that have a lot of money, that don't mind spending a lot of money on professionals related to transactions. Their LPs are used to it. They're comfortable with it. They're building a $1 billion business. To spend $500,000 on every little acquisition is fine. It rolls up. It's all in the math. To spend $500,000 asking questions, you can ask a lot of questions. Okay. And so what we find is that the large strategics, they'll do a lot of this internally. They've got their own lawyers. They've got their own accountants. They'll do a lot in-house. And those people are busy and not trying to bill by the hour. They get paid a salary. And so if they can be more efficient and just cover what matters, that's how it gets done. So there's this interesting bifurcated market that says, for the most part, if you are a small buyer, you're probably going to ask limited due diligence. And if you're a very large buyer, you're going to ask manageable due diligence. And if you're a middle market private equity firm with money to burn for professionals, those professionals are going to do what's in their best interest, and they're going to bill by the hour. I mean, is that surprising? Is that rocket science? No, of course not.
So it sounds like the best target buyer is the large buyer, because not only are they going to pay you more, but they're also going to do less due diligence, which is a real headache. Due diligence, it takes a lot of time.
Yes. Now, look, we work with private equity firms that are very efficient and rational in their due diligence. There are some out there. But yeah, that's been our overall experience. Generally speaking, private equity firms that hire teams of consultants and professionals tend to ask the most questions. And we believe sometimes some of those questions are not really value added. Sometimes.
Got it. So another question here, in regards to the private equity with the eventual IPO, can you speak to the arbitrage between private market valuations and transactions,
Yep.
and then public valuations after IPO? For example, the Carmen recent IPO.
Yeah. So I am not a public equities guy. And Nate, you work for Raymond James, which is one of the best in the world at doing this. And so I would say to your questionnaire, the person asking the question, better to ask Raymond James than me, but I'll try to give you a quick answer. The public markets trade differently than private markets. And the largest is DLOM, DLMC, discount for market liquidity, right? And it's rational. It's not some funny number, or we're taking advantage of you, or it is. If I own a private company, I do not have liquidity. I can't call up Nate and say, look, I need $3 million, sell some of my whatever. No, you can't just sell 3 million of your whatever. Now, if you own Google, you can call Nate tomorrow and say, Nate, how long would it take to sell $3 million worth of Google? And he would say, it's done. Have any more questions for me? Right?
Absolutely.
And so that liquidity is extremely valuable. It's not a game. It's not arbitrage. It's not funny. I mean, it is arbitrage. There is an arbitrage there, but it's not some irrational arbitrage. It's, if you have true liquidity like that, that's extremely valuable. Well, if it's extremely valuable, that means the prices are different. So, $3 million of a Google stock that you can't sell is not worth $3 million of Google stock you can sell in 3 seconds. Common sense. And so there is a huge arbitrage there. I'm not trying to belittle the arbitrage comment. It's a great comment. I just want to make sure we're all understanding that it makes total sense tied to liquidity, that if I had the ability to sell my private company $3 million at a time or whatever, whenever I wanted, it should trade for a different value because that liquidity is worth so much.
Excellent points. Excellent points. We have time for one last question, and I will ask this question, which is, are you seeing a lot of interest from international companies these days? And how does it impact their situation in tariffs?
It's a great question. So my deceased mother said, you don't talk politics or religion with people you don't know well. So I don't talk politics with people I don't know well. And we have clients truly on both sides of the aisle. Okay. And we love all of our clients. And ignoring politics, right? So I'm going to ignore the how we got where we are, whether it's good or bad. But I'm going to talk about the impact of these political decisions. Okay. So no comment about good, bad, or indifferent. Comment about where are we? At the moment, tariffs are not having a big impact on what we're doing. There was a moment in time when the tariffs on certain metals was causing concern in our sector. That has gone away in large part due to the EU reaching a trade agreement with the US on aerospace. There's a 1979 GATT agreement between 33 signing nations. US is one nation. The EU is one of the 33 signatories. And it said no one's going to put tariffs on anything that goes on an airplane. Okay. From beginning to end. And they added simulators. I'm not sure why, but they added simulators. So it's all exempt. So the stuff that goes into them and the repairing them and the parts, all exempt. Now, only the EU has formally said they're accepting to maintain that agreement with the US, and Donald Trump and President of the EU, they were in Canada, I think, and they agreed to this. It's not in writing yet, okay, but it's agreed. So that stabilized things back down. So we're yet to see any meaningful invoices, payments on tariffs anywhere in the sector of our clients. We don't see it yet. Doesn't mean we'll never see it. We're not seeing it. So in terms of are tariffs being paid, and is that impacting our company's earnings and their attractiveness to buyers? No, not at the moment. Second question, are we seeing more foreign buyers? Absolutely. More so than I've seen in my entire 40-year career. Period, full stop, not even close. And I've never seen manufacturing attracting this much capital in my 40 years of experience. Manufacturing is a very attractive sector, and buyers are looking for manufacturing in aerospace and defense more so than I've ever seen in my life, by a very large margin. Now, the only complicating factor to that is, and we've got one deal we're selling right now where roughly half of the buyer community that we're talking to are foreign. Foreign allies, I mean, no South Korea, thank you very much. I mean, North Korea. South Korea, you're welcome. North Korea, you're not. But there are foreign true allies of our country in our process. And the only complicating factor there is that you have to do a CFIUS filing, which is a little bit of a rabbit hole. But CFIUS is a unique piece of our legislative, of our laws of this country that are non-appealable, and they do not have any statute of limitation. And effectively, a foreign buyer buying anything in the United States has to go before CFIUS, defense or not, and get approval. The deals we're doing are pretty easy to approve because most of the foreign buyers are already in some way suppliers to the United States in some way, shape, or form. So they already do business with us. They're not, nations we've never done business with. But that is a complicating factor. Okay. And CFIUS is being aggressive now. And you've read in the news things like, Chinese buyers of farmland in the Midwest being blocked by CFIUS. So the answer to your question is tariffs, no impact at the moment. Politics, manufacturing in the US is very attractive right now to foreign buyers. Caveat, you have to go through CFIUS for almost all transactions today, and the administration effectively has a veto.
Fantastic. Well, that is all the time that we have. Thank you all for attending and asking such good questions. And Bill, thank you so much for sharing your knowledge, your insights, and your experience. This was a really helpful and a really wonderful conversation.
Thank you, Nate. Thank you very much.